Hello everyone and welcome to our webinar, and thank you for joining us today. What we're looking to do is to tackle the complexities of wealth tax in Spain. My name's Sam Daynes. I'm one of the senior associates here at Holborn Assets, and I'm joined today by Alvaro Villar Nunez, who is a lawyer and a partner at Martinez-Echevarria, who a lot of you may be familiar with. Due to the social distancing rules, we are actually working in offices right next to each other, literally across the way, but obviously due to social distancing, we're both in our respective offices today, which is an office near Porta Banús. Just to give you a little bit of a background in terms of Martinez-Echevarria, they were founded in around 1983, and the idea really is to give quality and professional excellent advice in the field of legal and tax services. And that's really why we're teaming up today. They have over 250 professionals operating in Spain, Portugal and Turkey, and they do have an excellent reputation for quality and accuracy. Following this webinar, we're happy to take any questions, or alternatively, if anybody wants any private consultations, and obviously all they need to do is contact us, we'd be more than happy to do that. With regards to myself, you may be familiar with some of my previous webinars, but I'm one of the senior associates here at Holborn, and we very much focus on providing tax-efficient investments, pension solutions, that sort of thing, and predominantly for people in Spain and inside the EU. I've worked within the industry for over 24 years, including working for HSBC and various other organisations, and I've been based in Spain for the last sort of 5 or 6 years. So hopefully together we do have the knowledge and expertise to help anybody out there, and we'd be more than happy to do so. What we're going to do in the format, well, Alvaro will just run through a sort of brief presentation, and hopefully that will answer a lot of your questions. But some of the areas that it will cover would be things such as what is Spanish wealth tax? Are you potentially liable for Spanish wealth tax? What are the sort of tax rates and allowances? And are there any exclusions and limits and that sort of thing? And then at the end, if there's any questions that anybody has, then obviously please feel free to send them through. And that really is what we're planning to go through today. So hopefully it will add some value for you and answer some of your questions. So Alvaro, thank you for joining us. Over to you. I'd love to sort of see what you've got to say with regards to this.
Thank you so much, Sam, and thank you, Holborn, for the opportunity of presenting this event with you. We are very proud of being partners of Holborn for this short period of presentations on issues of interest for impacts on the coast, which are all the time here and in many occasions not so well known by many people. So we try to clarify some of the basic aspects of these issues. As you've said before, well, I'm the partner in charge of the tax area at Martinez-Echevarria and Rivera law firm. I'm experienced for over 17 years in taxation and as a partner in different firms. And now we've joined this team, and incidentally, it happens that we, as you've said, we are just opposite next door. So we have this opportunity of working together, which I think it can be very, very good for our mutual clients. So if you want, we can go to the presentation.
Fantastic.
Which the topic for today is. I will share the screen. So, as you've said before, topic for today is wealth tax in Spain. particularly as non-resident taxpayers are concerned. So, first of all, what is needed to specify is that many people don't know that wealth tax only applies on individuals, not on companies. So wealth tax is a tax for natural persons. So many people could ask why then it is said that companies can be taxed by wealth tax. In reality, it's not that companies are taxed by wealth tax, but the persons who own the shareholding in those companies are instead. So only individuals can be liable to wealth tax in Spain. And there are two different ways you can be taxed by wealth tax. Either if you are a resident in Spain, you would be taxed on all your worldwide assets, and you could deduct all your worldwide liabilities. Quite the opposite. If you are a non-resident in Spain, then you would be only taxed on the basis of the assets which are based in Spain. But in that case, the liabilities you can deduct from those assets are very limited, and are limited only to those which are directly linked to those assets you own in Spain. So in the event of a non-resident taxpayer, you know that residency is determined in Spain by being in the Spanish territory for over 183 days, or also if you have your main base of economic activities or wealth in Spain. But most likely for a person who lives abroad, the main point of concern is whether I spend over 183 days in Spain or not. That's what happens more often. So being careful of not exceeding that threshold, you would be treated as a non-resident in Spain. On that basis, you would be only taxed for wealth tax in Spain for the assets you own in Spain. So how the taxation is arrived? In reality, wealth tax is a quite simple tax, because it's just the market value of those assets with some specific rules, and then you apply the scale of tax rates, which ranges from 0.2% up to 2.5%. So that's an easy as such. So you would think there are a little opportunity to escape from that. Well, one very very simple tip for people who can be catched by wealth tax in Spain is that there is a basic tax relief as to wealth tax in Spain, which is 700,000 euros. The first 700,000 euros are exempt from taxation. So if you are under that threshold, you have nothing to take care about. If you are over the threshold, you should consider how you have your ownership of the assets in Spain structure. Because if, for instance, you are a couple, for instance, we are talking of two spouses, then if only one of the spouses, because you have separate assets, own the property in Spain or own the assets in Spain, then only one of the individuals of the couple would take advantage of those 700,000 euros. If you divide the assets among the two of you, then both of you would take advantage of those of that 700,000 euros tax relief, and in that case, the tax relief extends to 1.4 million euros. So that's quite simple. That's very basic, but it's quite effective, because there are not so many people exceeding 1.4 million euros of wealth. So, and another tip we can mention. So if I own an asset I'm, for instance, with my partner, and I'm over 1.4 million euros, I couldn't escape from wealth tax. Well, there are certain ways which are a bit more sophisticated in order to try to mitigate the tax burden. As I said before, wealth tax, the basis of taxation is assets less liabilities. So in other words, we are talking of the net assets. So if you have taken external financing to buy the asset, then that financing could be deducted from the value of the asset, and that would reduce your wealth tax liability. But the Spanish tax authorities are quite strict as to the requirements for that liability to qualify as a reduction for wealth tax purposes. If the liability in the event of non-resident taxpayers is not directly linked to the asset, in other words, you have applied the funds obtained by the external financing to the purchase of the asset, then the liability wouldn't be deductible for wealth tax purposes. Indeed, in the past, the criterion of the Spanish tax authorities was that only mortgages which were granted by a bank were deductible from the value of real estate assets located in Spain. Now they have opened the criterion, and they accept that external financing, so it can be from external financial provider, is eligible to deduct from the value of assets located in Spain, providing that that financing has been applied for the purpose of buying the asset in Spain. So it could be even a related entity granting a loan to you in order to buy your home in Spain, or to buy whatever other assets or financial assets in Spain, whatever you have in Spain. And that loan in theory would be valid for the purposes of reducing the tax burden as wealth tax is concerned. So going further to a bit more sophisticated, many people have been told, well, if you just set up a company, then you are not liable for wealth tax in Spain because the assets are owned by a company. So as we said before, the tax can be demanded on an individual basis. The company is not an individual, then the company cannot be taxed. So this was a very common mistake in the past. Many people saying if you set up a Spanish company, then you are no longer liable to wealth tax in Spain. Well, we must say this is not true at all, because instead you are replacing real estate assets or other sort of assets for the shareholding or the stakeholding in the company. But still, we are talking of shares which are issued by a Spanish company. So for legal tax purposes, it would be considered assets located in Spain. So they are still taxable in Spain. So you haven't improved the situation, and you have added an additional cost to the equation, which is that of keeping the company running. It's true that having a company can have some advantages in terms of, well, if I have a company owning my assets, then maybe the company could have that financing from external financial providers, and at the end of the day, the basis on which I'm taxed is the equity of that company. So in those cases where there is a massive contribution from external financing, and the equity of the company is proportionally low, then maybe there is an opportunity for a tax relief, but not before having carried out a proper analysis of the financial structure of the transaction, because owning a company in Spain per se does not relieve you from wealth tax in Spain. And in a third instance, maybe a bit a level above, which is not just setting up a company in Spain in order to own my property or my assets in Spain, but even I set up a company abroad with or without a subsidiary in Spain, which is the ultimate owner of the assets, or just the foreign company owning directly the assets in Spain. So one could say, and that was the traditional criterion, one could say, well, I do no longer own assets in Spain because what I own are the shares in the foreign company. So that's out of the jurisdiction of the Spanish tax authorities. Well, that's quite true, but a recent interpretation from the Spanish tax authorities has stated that in those cases where there is a double tax treaty are conventions between countries in order to avoid double taxation in the event of conflicts of jurisdiction as to taxes. So, for instance, there is a double tax treaty in force in between Spain and the UK. So, the Spanish tax authorities have said, in those cases where there is a double tax treaty in place, and the tax treaty says you are able to tax shares in companies whose underlying assets are made up of real estate located in Spain, in those cases, even though we are not talking of assets in Spain, we understand, the Spanish tax authorities, that we are being assigned jurisdiction in order to tax those shares. So you can end up being taxed for owning shares, for instance, in a UK company, owning a real estate asset in Spain, or a UK company owning shares in a Spanish company, which in turn owns a real estate asset in Spain. That criterion from the Spanish tax authorities, in our opinion, it's not correct, because while it's true that the double tax treaty could assign you jurisdiction in order to tax shares in companies, if at the end of the day you don't have that jurisdiction because it's out of your territory, they are assets which are completely out of jurisdiction, you can have been assigned with that jurisdiction, but it should be devolved because both the taxpayer and the assets are abroad, so you lack that jurisdiction. That's the criterion which recently, in 2020, has been stated by the High Court of Justice of the Balearic Islands, which has stated that the tax authorities was wrong, and even though there was a double tax treaty saying you have the jurisdiction to be able to tax, if at the end of the day the domestic legislation doesn't assign you the authority in order to tax that kind of assets, you couldn't do that. In any event, we do not recommend to implement these kinds of structures just for the purpose of trying to mitigate the tax liability, because at the end of the day, you are subject to a great degree of uncertainty, and at the end of the day, you can be incurring in substantial cost in order to implement the structure, and at the end of the day, it could be without any purpose. So I think at the end of the day, there are little magic formula in order to try to avoid wealth tax. There are some basic tips as to the basic tax relief, and also that if you buy the assets in Spain taking external financing, then there is an opportunity for a tax relief, and that setting up complex structures, if just for the purpose of trying to mitigate the taxation at the end of the day, can be useless. However, if you have to set up the structure for legitimate economic purpose, at the end of the day, you can structure some sort of tax benefits if you structure the company properly from a financial perspective. So yeah, this is basically what we want to share during our presentation of today. And thank you so much for your attention.
Well, Alvaro, that's really, really useful. There's some information in there, which again, I mean, I haven't been familiar with. So there's some great stuff in there. I've had a few sort of questions pop up here, so I'm gonna throw you in at the deep end, as we say, and just ask you a few of these. Just as I say, I think you've covered a lot of things there, but with regards to wealth tax, is there any regional differences in Spain? Does it matter where you are, or is it going to be the same whether we're here or whether we're in Barcelona?
Well, that's very curious because indeed, for non-resident taxpayers, it used to be a bit of the same, because traditionally non-resident taxpayers were subject to the tax rates of the basic legislation, which is that passed by the central government. But from some years ago, non-resident taxpayers which are resident in the European Union, taking into account the situation of the UK after Brexit, which is no longer European Union, they are entitled to elect or to opt for the legislation of the region where most of the assets are located. So traditionally, the tax rates approved by the central government in Spain were lower than those of the regions. But Junta de Andalucía has approved this year for, in 2020 for 2021, they've passed new tax rates, increasing the upper tax rate, which originally was 2.5%, now is going to be 3.5%, while that of the central government is still 2.5%. So it can happen that even though you are entitled to opt for the regional tax rate, at least in Andalusia from 2021 on, it is more advantageous to opt for the governmental tax rates. So that's important you discuss with your tax advisors. Well, when the application, when the IRP of your tax firm or your tax advisors apply the rates, double check that the rates applied are those more advantageous in your case, because you can opt for applying those from the central government or those from the regional tax authorities. Now, if we come to the situation where you maybe are living for longer in Spain and you are on the verge, or maybe you've become resident in Spain and you are concerned because you are going to be liable to all your assets worldwide. In those cases, you must take into account that is well known that Madrid offers full tax relief for residents in the region for resident taxpayers. So if you are to become a resident in Spain, there are many people which take a look at the possibility of choosing Madrid as a destination of choice, because Madrid leaves wealth tax exempt when you are resident in the in its territory.
Right, now that's really interesting. And I've had a question pop through here as well. And with regards to wealth tax generally, is there an upper limit set? I mean, you know, wealth tax itself, can it only go up to a certain amount, or is it just infinite in how far you may have to pay?
Well, in theory, there is no limit. The reality is that when you are to become a resident in Spain, you have certain mechanism which allows you. So large family offices or large wealth holders have the opportunity to structure their assets in operating corporate structures. Yeah. In those cases, operating corporate structures are exempt from taxation, and it happens. So that's an opportunity in order to plan your wealth tax burden in a way which is more acceptable. If you really have investments which are active investments, creating or operational investments, that sort of investments can be left exempt from wealth tax. So if most of the assets are placed under the umbrella of these kinds of corporate structures, providing legitimate operational business, that part of your assets would be exempt, and maybe the assets which are taxed are much lower. Right. Additionally, if you are in that situation, talking about again as talking about the resident taxpayers, but if you are in that situation where you are asset rich but cash poor, there is a limit, which is you cannot be taxed for wealth tax plus personal income tax over 60% of your yearly income.
Right.
So at the end of the day, they cannot demand you the payment of wealth tax in excess of 60% of your annual cash earnings. So what you need to live. So at the end of the day, you must be left at least 40% of your income yearly.
Right.
After adding personal income tax liability and wealth tax liability. So in those cases, when you are asset rich but cash poor, you have that limit, which in many occasions limit wealth tax very, very substantially. Yeah. In that case, there is something which must be taken into account, which is wealth tax liability for as a consequence of that reduction cannot go below 20% of the original wealth tax liability. So you cannot limit wealth tax liability over 80% of the original tax liability, which would have been payable. But in any event, you can make very, very substantial savings by applying that joint 60% tax limit.
That's really interesting. Well, I'm sort of conscious of the time now, Alvaro. I think we're it's nearly 4:30. I don't want to take up any more of your time. I just want to say, I mean, we are no doubt going to get some more questions come in. So obviously I can fire them over to you. And as I say, you know, certainly from our point of view, we would sort of thoroughly recommend people speak to yourselves about these sort of situations, and obviously anybody that would like to contact me or Alvaro, please do. But for now, I just wanted to say a huge thank you for your time now, Alvaro. I'm sure a lot of people watching this from their houses will have learned a lot from that. I certainly have. So yeah, thank you very much for your time. And as I say, we'll be in contact with anybody that's looking for any advice. But yeah, thank you so much.
Thanks to you, Sam, and very, very nice to having shared this time with you.
Lovely. Thanks so much, Alvaro.
Thank you. Bye.
Bye-bye.